Greetings traders and welcome back to another In-Depth with Chris episode. In today's discussion, we'll be talking about scalping. And no, I don't mean the reason behind why I'm bald, which actually isn't scalping at all. No, I'm talking about scalping as it pertains to trading. This is how it pertains to stocks. This is how it pertains to futures, Forex as well. We're going to cover all of that and more, so make sure you stick around. And if you haven't already, please do me a favor and click that like and subscribe button down below so I can keep coming out with content for all of you out there. Now, without further ado, let's get going so you can be on your way to passing that gauntlet mini. Here we go. The concept of scalping is important to understand even if you don't have any desire to scalp yourself, because traders that are scalping are in fact adding liquidity to the market and affecting the market dynamics, so therefore they're impacting you whether you're using it or not. How rude. But first, let's cover what scalping is, at least as it pertains to trading. It is a trading strategy that's commonly used by traders who are looking to pursue small profits through marginal movements in the price of a stock. So small movements in the price, small profits generally out the other side. The trader exits the position when they achieve their target price without keeping the position intact for further gains. Scalpers generally have a strategy to exit an unfavorable trade at a moment's notice. Such an exit plan is always necessary in this kind of trading to make sure that their risk to reward isn't getting too off kilter. And when you're looking for shallow take profits, you need to make sure that your risk scenario, your stop loss, is also shallow as well. This type of trading is a contradiction to traders who enter positions with a longer time frame in mind or any type of long-term strategy involved. And that's because the latter type of trader, that longer-term trader, is generally looking to maximize the profit that they can possibly achieve from staying involved with something for the longest time frame possible, as long as they believe it will continue to rise. And they don't mind staying through various periods of shortfall in order to get that long-term gained. We can consider scalping a more dynamic form of intraday trading. The trader executes hundreds of trades in a single day. The risk scalpers take on any one trade is typically small, and they usually close their positions quite quickly regardless of the amount of profit or loss, in that case, being quite shallow. Some of the most common features of scalping are listed here in these 5 categories. The first is trading on small movements in price. Even when there may be a possibility of a larger continuation in the direction of the trade that they've opened, meaning the scalper, they still will close out their trade because generally they believe it's not as risky to keep that trade closed, lock in that profit instead of go for those big gains. The second thing is that positions are held for a very short period of time, and this kind of goes hand in hand with that concept. The target price or target stop loss that a scalper is going to use is usually so close, which therefore means it's generally achieved within a matter of minutes. The reason behind this is the less overall time that this scalper has its position open, the less risk they view that they're maintaining or currently exhibiting themselves to. Number 3 is liquidity is essential for scalpers, and this is important to understand. To execute a very large number of trades in a very short period of time, it's extremely important that whatever asset the scalper is trading is very liquid. That way they can get in and out with ease and at the correct prices that they actually want to. This is very, very, very important to understand, because if we go to scalp something with a strategy that was working previously with a liquid pair, but we go to an illiquid pair, just because we're using a winning strategy, we could still all of a sudden end up with a net loss because the pair itself is just not liquid enough to allow us to operate at a maximum level. Then we have access to real-time trading platform with minimal latency. What this simply means is we want to trade on a trading platform that is executing our orders in as close to real time as absolutely possible. The faster our orders are executed, the better off we are, especially as a scalper. And then number 5 is high trading costs. Since the number of trades that a scalper takes in a given day is high and the profit per trade is generally small, a scalper would want to cut down on the trading costs, especially things like commissions, to make sure that they're improving their overall profit scenario. One of the ways scalping works is by exploiting bid-ask spreads. This is a strategy that involves buying at a lower bid price and selling it at the higher ask price. This is a relatively simple, but it's not that easy way to make profit because you have to be very quick and you have to pay attention and find these types of spreads. These spreads are relatively stable and they can generate a small profit that adds up for a scalper. However, it should be noted that the price differences when using this strategy are generally tiny, and the spread could adjust to lower levels, and it could end in a negative way for the trader if it adjusts in a way that is just not beneficial to the way that spread was previously listed. Some other strategies that are quite common in the scalping world, or tools that are used commonly in scalping strategies, include the exponential moving average. This is the exponential form of the simple moving average. It weighs more recent price heavier than past price. And what the exponential moving average can do for scalpers is let them know that price is currently trading above that exponential average, meaning it might be getting a little overextended if the markets are trading sideways. So if the markets are trading sideways or range bound, that's usually a condition that scalpers love to see. In that case, if price was trading above an exponential moving average, it's probably quite expected in the scalper's mind that price is about to return downwards, and they'd be looking to ride price back to or below the moving average and then just simply get out. Then we have volume and price action. Price action is just generally speaking Japanese candlestick analysis. This is paying attention to the ebbs and flows that price is making and using that information to get a read on what's coming next. And believe it or not, just like a pin bar is important to showcase the price direction that might be coming in whatever it is that we're analyzing on a monthly chart, that information can also showcase very similar results all the way down to maybe say a 5-minute chart or even smaller. So scalpers will use that type of analysis to find out when the market might be making just a very slight jump in one direction or the other and look to take advantage of it. Then we have Bollinger Bands. Indicators like Bollinger Bands always showcase very easy conditions for scalpers because it showcases a deviation off of a center line. And what this means is it gives you an idea of how extended or how erratic price is being based on how wide the Bollinger Bands are apart, as well as where price is in location to any of those three bands. As well as if it's outside all three bands, that could be something very exciting for a scalper to see, but it is important to understand that when the market begins trending heavily, it can ride outside the Bollinger Bands as well. So it's important to understand that the market using these extension parameters with the exponential moving average and Bollinger Bands should be done with price action to make sure that you're not just riding a trend or riding against a trend, so to speak. The concept of scalping originated on stocks, but it is quite comparable how it is done across the board, and it can indeed be done on scalping with futures, scalping with forex, and obviously scalping with stocks. With futures, using scalping is a high-risk, high-return strategy. One needs a reasonable level of expertise before doing this type of thing because that high-risk factor. Futures trades can be closed out after gaining a small profit, making it possible to scalp. By putting an initial margin down, a trader can gain exposure to a higher volume of assets, thereby maximizing their capital efficiency when they are trading with futures. When scalping with forex, we are doing the same concept where we're looking to take part in these slight moves, and generally scalpers are using technical indicators to determine the correct time to enter and exit their trades. Many currency pairs are very liquid, and this is what a scalper needs and what a scalper wants. Scalpers can also take advantage of the bid-ask spread that exists in forex, as we mentioned previously, in order to take some extra profit on the side. And then we have the concept of scalping stocks, which is quite literally everything that we've been talking about as well. This is where we're going to use those technical indicators or price action to get an idea of when a stock's price might be going up or down. Now, scalping on stocks in today's day and age can be actually a little bit more difficult in terms of getting in and out compared to some of the more liquid forex and futures options out there, but it indeed can be done. The number one rule is just make sure whatever it is that you're looking to trade, that it's liquid. If it is liquid, in that case, you should be able, in theory, to scalp it. Deciding to be a scalper is something that's going to be a very personal decision. You need to decide if you're the type of person that likes your trades being open for only a very short period of time, but you're very comfortable in your process and you're okay taking many trades and knowing that you're going to adhere to your process. You like the idea of getting in and out just like an assassin. Or if you're more of a trader that kind of likes to ride positions out and take advantage of a long-term trend, then scalping may not be the choice for you. It's up to you to decide what one is your preferred trading style, as you would expect, but the only way that you'll ever really know is to actually get out there and practice. And you can use a demo account in order to practice your scalping techniques and see how you do. You'll get a feel for it, and that's what I recommend. Until next time, thank you for joining me. As always, folks, best of luck out there. Happy hunting, happy trading. I'll see you soon. Bzz.